Hi everyone, my name is Ishaan Gupta,
And my name's Arnav Chitari.
and this is our restructuring case on Cumulus Media for the Pari Passu competition. The ticker for Cumulus is CMLS on the over-the-counter markets, and our tagline for today will be a capital structure going off air.
Yeah, so for a quick overview of the business, Cumulus Media is a national radio broadcasting company which owns and operates over 403 different radio stations across 85 markets. They own the Westwood One radio network and have their own podcast network called the Cumulus Podcast Network. And they cover a lot of different political commentary through things like the Daily Wire, the Ben Shapiro Show, and then they also have licensing agreements with iconic brands like the NFL, CNN, AP, and more. But the company is historically compromised. As you can see on the bottom left, sales have fallen 6% year over year since 2018. In 2018, they actually exited Chapter 11 bankruptcy, and even since then, their leverage has continued to climb to dangerous levels, and their interest coverage has similarly been depleted. And you can see the struggle really visualized through their share price decline on the top right. Um, Ever since they exited Chapter 11, their share price has just been on the downturn. Um, Once they had the hostile takeover happen to them, which they were able to circumvent through a poison pill, that just spelled even more investor disconfidence. And that led to their shares ultimately being delisted due to no longer meeting their requirements. And overall, we've just seen a very consistent compounding downturn because of this secular headwinds they're dealing with, and the struggles of the business in general.
Yeah, definitely. To piggyback off what Arnav said, that's really what's kind of been the thorn in the side of the neck for Cumulus Media is really kind of just the industry in whole. We like to consider it more of an industry in free fall, and really just coming from a grim outlook on the TAM overall. We see that based on S&P market intelligence research that projections for revenue growth are slowing and declining actually. Even from an on-the-ground perspective, a very small percentage of adults are actually like using the radio for their news, for their information. So I think as a whole, the radio industry is just a niche that's slowly falling and succumbing to more digital trends. If you look at Humus specifically, we kind of look at a snowballing effect that's come from a lot of their previous exercises. Look at the Chapter 11 from earlier, from a few years ago, and really there was two main takeaways from that. First is with the equitization of loan holders, there's just a misalignment in terms of management incentive. You're looking at management who's now just looking to drive recovery rather than drive business value in the long term. We look at the debt exchange from 2024, which happened very, very recently. This just added incremental collateral. The enhanced economics created a very large interest burden, and it's just really not been great for the business in terms of creditor relationships as well. Adding these two together, and you have a recipe for disaster. Plainly put, it's distressed. It is being traded as if it is distressed, and based on previous exercises, it most definitely is. Looking ahead to the future as well, from a debt perspective, it's hard to be optimistic about this company. We look at their maturity walls, and yes, have enough liquid right now to meet the 26 maturity wall quite comfortably, actually. But as you can see, that 2029 maturity wall is extremely large. You have a revolver, you have a term loan, you have senior notes coming due, all each in very large tranches. Thus, we have dubbed it the Thanos dilemma because, in a sense, it is inevitable. And it'll be extremely difficult to refi, as said by petition as well. We've got similar sentiment from calls we were able to have with creditors. On a call we had with a firm called Holbrook Holdings, which are some of the 2026 senior notes, we were able to really kind of come home to the point that it's a harder space and that 2029 will prove to be difficult. Similarly, in a conversation we had with the South Dakota Investment Council, which is invested in the 2029 due term loan, they once again just echoed how hard of an industry it is to be right now, and that if you're a lender, you're not very confident to be here at the moment. And yeah, I can dive a little bit deeper into the capital structure as well. Here we've laid out all the tranches of debt in collateral priority order, as well as their cash positioning right now. A few key takeaways from this. First of all, is how low the senior notes are trading. I mean, the senior notes through 26 are trading at around 61 cents. The 2029 senior notes are around 27 cents. That's incredibly low, incredibly cheap, and I think incredibly telling of just how distressed investors are viewing this company. Of course, we're looking at a company whose equity trades over the counter now as well. So all signs are not pointing in the great direction as well. I think another important note here is with the revolver, considering revolver is often a proxy for liquidity or a beacon of liquidity as well. And that while there's 125 max drawing capacity, the borrowing base is actually tied to 85% of accounts receivable. So which means that at its current positioning as of its latest filing, the max draw capacity in total is actually closer to 114 million. Just looking a bit deeper into the leverage, we can see that on a leverage compared to an EBITDA basis, 9.92x, not an amazing place to be in at the moment. Debt equity is completely off the charts, to be honest. And then even if we look at an entity structure, it's an incredibly dense entity structure that comes from a past of M&A, which will just kind of prove to continue being difficult. But it's also important just to quickly note that 100% of the debt is actually held in the subsidiary called Cumulus Media New Holdings Inc., which we have highlighted on the diagram on our bottom right.
So to get into the strategic business plan, we can see that on the graph on the left side of the slide, their network volume and overall broadcast volume revenue in general has been on the decline as that sector in general sees less and less demand over time. Meanwhile, their digital revenue is actually the only growing segment on their income statements, and that's a result of what those digital marketing services actually are, which are essentially digital ad operations that marketing and campaign management networks want for advertisers to reach audiences. And because Cumulus has 250 million plus listeners, they just have a very big potential monetization through monetizing the data of those listeners for those advertisers, and their digital marketing services have been growing as a result. And to kind of quantify this, we ran a log regression of content spend versus broadcast revenue, and we ended up finding through there that for every 1% increase from Cumulus's behalf in their spending on content costs, they're only reaching a 0.56% increase in broadcast revenue, which is really just quantifying that their spending on content has been a marginally value diminishing expense, and that has really caused them to be burning cash over time. And so we're suggesting that they transition from their radio station focus over to more of this DMS by, you can see on the top right, stepping down their capital expenditures on radio stations, and then also doing some divestitures of fixed assets that are underperforming. And while this will obviously have a liquidity boost, we also think this is just a strategically correct decision because that would focus you more on the segment where you're actually growing. And so because Cumulus has already extended its maturity wall past the 2028 site, where a lot of companies are struggling right now, they have the runway to undergo the strategic calibration and sell off their cash burning assets, and then keep their performing content infrastructure, but more so focus on monetizing that listener data through this extended runway that we have. And through this plan, we can project, as you can see on the bottom right, material value capture, 37 million plus of free cash flow capture through this plan, which can set the stage as well for further transactions. And then getting more into the valuation, this is just a quick overview of the different valuation methods we ran. So we did a DCF, comparable companies, precedent transactions, and a liquidation valuation. And through this, we got a range of their implied EV that we are pretty confident about, which helped us inform our later strategic recommendation. But first, we'll get more into the nitty-gritty of our actual valuation methods.
Of course, yeah. We'll start with our public comparables approach. So with our public comparables, we tried to find companies as close in the niche of Cumulus Media as possible. And while sparse, were able to arrange a decent list. In terms of a max and a minimum, we used the maxes and minimums we found from a median and a mean perspective as well. And I think a few key takeaways that we found from this were, first, I think it's important to look at how low a lot of these companies are trading at in terms of a percentage of their 52-week high. Looking at a lot of these companies trading in the high 30%, 75%, 83%. It's a grim place to be in right now. All things said, if you look at Cumulus Media, yes, they're trading at 100%, but their stock is also 12 cents. So there's not a lot of value to be maneuvered around over there. In terms of what we used for our range that backed into our EV valuation range, we used EV over LTM EBITDA simply just to be as a proxy as much recently as possible to maintain as that recency. And yeah, I think public comparables tell a pretty consistent story with the rest of our valuation methods in terms of it's just a hard space to be in right now, and that investors are showing that across the board. Diving a little bit deeper into our precedent transactions, the way we thought about this was in two main ways. One was from a radio asset sale perspective, and two was from an illustrative, more of an M&A takeout transaction, more in the traditional sense. Now, the reason we elected not to proceed with the M&A and takeout transactions is simply because there aren't many precedents in this exact niche that that operates in this radio operation space. So as a result of that, some of the multiples may be a little bit skewed towards more digital type of companies, and we didn't feel was truly applicable. So we went more so with the radio asset sale, which, as we kind of mentioned in our business plan, and we will go into further in our restructuring plan as well, is much more in line with what we have envisioned for the business. Based on that, based on the mean and median multiples, we also considered a weighted multiple based on how many stations were actually sold in each transaction. Based on that, we also applied a premium to the multiple that we then applied for Cumulus, simply as a result of Cumulus operating so many more stations, many of which are much more premium than the ones that were considered in the initial multiples. And based on that, we arrive at an implied EV range of around 459 to $589 million.
And so we also ran a discounted cash flow analysis. You can see the front plate of it on the top left, along with the assumptions we used to calculate our WACC. And our methodology for the discounted cash flow was dividing their revenue segments into their spot and network revenue, which make up their total broadcast revenue, and then separately breaking out their digital and other revenue. For all of their broadcast revenue, we broke it up into four main drivers, which we then projected over the projection period. For spot revenue, that included their ad demand, CPM, listening minutes, and election year uplift. And then for the network revenue, it was essentially the same drivers except national ad demand. And then we also modeled out their network affiliate churn because their network affiliates are one of the main things driving that network revenue. And election year uplift is mainly just a driver because they have so many political shows. They have a certain seasonality baked into the business, which is that when it gets closer to an election year, they see a certain uplift in revenue. And then you can see that informed three cases that we separately broke out. The bull case projects that they do this strategic DMS execution that we were talking about before, which grows their digital revenue while relatively reducing their CapEx. And obviously that boosts their liquidity and their implied EV as a result. Our base case was just projecting in some success, but most drivers are over time going down, especially ad demand, listening minutes, and things like that. And then our bear case projects declines across the board, including with national ad demand, which is the only driver that's really relatively or slightly going up, just because national ad demand as a whole is on the upturn. But we also projected in our bear case that what would happen if they fail to execute on the DMS growth, which would just result in higher CapEx and then continually declining revenue because there's nowhere that growth is coming from as a result. And so from that, we derived a 466 to 627 million range in our implied EV. And then we also ran a liquidation valuation. Here you can see their assets ordered by liquidity. And the two key things that I want to highlight here are their PP&E. We broke out their PP&E radio stations by region because different regions have different recovery rates based on how much demand there is for radio in that region. And we derived those FCC licensing recovery rates based on the iHeart Media's Chapter 18 or Chapter 11 in 2018, which had a similar recovery rate of 25, around the 25% range. And then again, their intangible assets, which are the most valuable aspect of their business because it includes those licenses and those partnerships. For that, we modeled in a slightly higher recovery rate than you normally would for intangible assets of 25%, just because, again, that is the most valuable aspect of their business, and that is where we see most of the recovery coming from.
Great. So based on all those valuations that we included in our football field earlier, we ran a waterfall analysis using the low and high EVs. From those low and high EVs, we first added their liquidity, which once again was more of a function of the undrawn capacity that they still had left on the revolver, plus any cash and cash equivalents that they had. And we arrive at a total distributable value, which we then ran through our company's capital structure. And I think the value of the results of the waterfall are not too surprising. Value is scarce, to say the best. The 2029 term loan and the 2029 senior notes are pari passu to one another, creating an incredibly large pari pool right below that revolver, which is also due in 2029. And we see in our bear case that that pari pool gets a 77% recovery, and everyone below that gets nothing. Once again, in a high EV, in our more bullish case, that 2029 pari pool will get a 94% recovery. And once again, everyone below them will get a 0% recovery on that investment. If you were to go to Chapter 11 right now, you would consider that pari pool to essentially be your fulcrum security. I do think it's important to note, though, that in reality, this is not exactly how it would play out, considering how small the 2026 maturity wall actually is. So from a chronological perspective, they will actually be fine for 2026. But this does go to show that, once again, 2029 is considerably inevitable, thus dubbed the Thanos dilemma. And so based on that, we can dive into our primary strategic alternative in terms of restructuring solution. So the crux of our solution has two main pillars. First are open market repurchases, and second is an LME liability management exercises. The open market repurchases stem almost completely from just how low some of the senior notes are trading on the market. Once again, 61 cents and 27 cents are extremely cheap, and we believe that there's essentially value to be had from an EV maximizing perspective by purchasing those notes right now. What we did is we modeled that if we were to completely purchase on the open market the 2026 notes back, and if we were to purchase around 25 million, invest around $25 million to purchase our 2029 notes back. And what you'll see is that in terms of the face that's actually retired or taken off the market, that it's extremely large, simply as a multiplier effect of how much is being put in. So as a result of that, as you kind of run through our waterfall again, as you run through the waterfall again, you'll see that there's actually quite a stark difference. In our base case, or in our bear case, we're seeing an 82% recovery, a little bit higher than that 77% before. In our high EV case, you'll actually see 100% recovery across the board. Now, I know that this may be unrealistic, and there are certain restrictions in how this may actually play in reality. For example, if they were to go through such a comprehensive buyback program, if they're going through such a comprehensive buyback program, it would be likely that debt starts trading a little bit higher, EV might start trading a little bit lower as well, and there may be some cash and liquidity considerations as well. So this isn't necessarily indicative of how exactly on a numerical basis it'll play out, but it is illustratively showing that it can work and it can actually create value going ahead as well. I think it's also important to note that in iHeart's LME, or in the iHeart Media case from very recently, they also engaged in a similar open market repurchase program. And due to some of their covenants, they actually, instead of retiring the debt to say so, they just held it on their own books and paid interest effectively to themselves. So while this wasn't mentioned anywhere in the docs that we read, that could also be done in case need be. Finally, a third pillar of the solution we're suggesting is in a Chapter 11 scenario. Once again, that 2029 maturity wall is a beast. It is a mammoth. There are chances that creditors play hardball. Maybe we weren't able to get everybody on the LME train. And that result, or Chapter 11, we actually do have our own strategy for that as well. And that is beyond the traditional maybe debt exchange, elimination of some debt, enhanced economics. We're also looking at some Section 363 asset sales, which align a lot with our business plan that we presented earlier, divesting some of those underperforming radio assets in favor of using some of the liquidity, not only to service debt, but then to also start shifting into that digital media space as well.
And to get into the details of what our LME would actually entail, we are proposing a voluntary transaction that creates a multi-tier exchange. So the first step of that would be creating a new super priority priming term loan, which would raise 150 million in new money, all of course senior to the existing first lien term loan, and that would be due in 2032. And so the people that participate in that would also exchange their first lien term loans at 85% of par and extend their maturity also to the 2032, 2033 range. And then finally, for the non-participants, that would be our subordinated sub. They would be subordinated to a par for par conversion that would be second lien and due 2033. And so while the solution, as you can see in the pro forma cap table, still leaves us at a pretty high amount of leverage because of the secular industry tailwinds and because of the fact that the company is so highly levered. In 2029, once they hit that maturity wall, a refi is unlikely. And so until then, this maturity runway just extends the amount of time they have to actually implement that strategic vision we were talking about. And then obviously the new injection of super priority capital just helps them fund that shift and that strategic shift to hopefully change the business. So by the time we reach this maturity wall, we're no longer just having to kick the can down the road and can do a more comprehensive delevering of our balance sheet. And then we're also considering, as Ishaan mentioned, if creditors don't play ball, we can do a Section 363 through a Chapter 11 where we can sell off any underperforming stations and non-core assets to, again, reduce bloat on the company and then also be able to focus more into that strategic shift that we want to do. And we know we can do this because we have a certain precedent from iHeart's 2023 sale leasebacks where we can test the multiples they use on our own assets. And then we also wanted to explain why we didn't go with some alternative popular transactions. We did explore a drop down because obviously this is a company with these extremely valuable FCC licenses. But we did find that there's certain covenants and regulations just moving those FCC license assets into unsubs a very difficult process that we don't think is worth trying to undergo. And then also with non-pro rata up tiers, recent rulings obviously with CERTA making the language around open market purchases a lot more hazy just makes it very difficult. And then we did contemplate even shifting to like the BetterHelp strategy of doing some sort of extend and exchange. But overall, those types of very aggressive strategies we found are just not worth it for a company like this that is still solvent and has the room to undergo a strategic revamp. And again, we used iHeartMedia to inform a lot of our decisions. Like Ishaan mentioned on the last slide, we know that iHeartMedia had to deal with having a springing lien when they did their open market repurchases. And so that's a consideration that we looked at. And they also underwent a comprehensive LME, which was mainly just an exchange, because now that we're on LME 3.0, which is favoring less this very intercreditor violence, prisoner's dilemma sort of LME, and focusing more into more pro rata maturity extension, which allows for shifting the maturity walls to a lot later and just having the time to revamp the business. We think that's the type of road that we would rather go down. And we also just have a graph showing how iHeart extended their maturity wall. That's something we see Cumulus very able to replicate through those open market purchases and through ultimately the LME that they would undergo. And so, yeah, that goes over our plan for Cumulus. We hope you enjoyed, and feel free to reference the appendix for any additional details on the calculation for beta, the log-log regression we ran, anything like that. But yeah, we're very grateful to compete and look forward to hearing back from Passu. Thank you so much.
Definitely. Thank you all so much.